What I've learned in markets like this is expect the unexpected. The Bay Area housing market has been cooling down now for many weeks. And a few weeks ago, I made a very bold prediction that we were at the beginning, the precipice of what would be called the hyperinflation period here in the Bay Area. And I was wrong. But now with the information that we have, the new data that we have access to, it's really easy for me to see what the future holds in store for the Bay Area housing market. And we're going to get into the data. We're going to get into the trends. But before we do that, if you're a home buyer in today's marketplace, you're looking for a comprehensive data set to assist you in your home buying decision making, you can text the word data plus the zip code, the neighborhood that you're looking in, and we will send that data straight to your inbox. And if you're a home seller in today's marketplace, trust me, your pricing strategy matters now more than ever, with inventory levels in some areas reaching 150% of where they were last year at this time. That's a lot more inventory. So pricing strategy matters now more than ever. You can text the word data plus your property address to the number down below, and we'll get all of the pricing information that your heart desires sent straight to your inbox. I wanted to take a break from the traditional stats-filled housing market updates to give some thoughts as to what's going on right now in the marketplace and give two possible outcomes as to how this all shapes up at the beginning of Q3 and into Q4 of 2022. For those who've been watching the channel for a very long time, you'll know that in 2021, I predicted exactly what's happening right now. I predicted that because of the early onset that we were seeing of demand and the shortage of supply leading into 2022, that we were experiencing an early spring market in 2022, very similar to what we saw in 2018. And that because of that, we would start to experience a slowdown in April. Now, that was my preliminary conclusion. That was my preliminary projection. And then I got caught up in the hype train of like, well, this market's never going to stop. And I made a bold prediction in the February-March timeframe that we were going to continue to see the market appreciate for the next 3 to 6 months. I was wrong, but I was right before I was wrong. I just want to make sure that everyone knows that. But why did my opinions change, and what is it now that I expect to see, given that historically speaking, we're seeing things play out very similar to what we saw in 2018. There are some similarities, yet there are some differences as well. So I want to point those out and give two possible outcomes as to what's going to happen here in 2022. The data in late 2021 and early 2022 gave me reason to believe that we would see a market very similar to 2018, where in mid-April, we would see a decrease in demand and an increase in supply. It happened in 2018, and the same thing happened this time around as well. The issue is that in February, March timeframe, we didn't see inventory levels go up as much as we're used to seeing in the spring. And so because inventory levels stayed suppressed and demand continued to rise dramatically, I was under the impression that there is no way that we could stop this train, that was going to continue. Obviously, interest rates had started to rise, but not as dramatically as they have over the last couple of weeks here. Coupled with the conflict in Ukraine, I expected that to have a negative impact, or an impact on the Fed, meaning I expected the Fed to react negatively to the crisis in Ukraine longer and continue to suppress rates and actually bring them down, which happened for a little bit, but not as long. That didn't last as long as I expected it to. Not only that, but the stock market has just been very uncooperative here, to say the least, over the last 2 to 3 months. And so that has definitely caused a lot of buyers to pull back. Not only are rates going up, but my stocks, but the liquidity of my portfolio is taking a nosedive, because honestly, like, who wants to liquidate their portfolio at 50% of what it was 6 months ago? And that is the case. That is a very harsh reality for some home buyers here in the Bay Area. Here are two very real possible outcomes for the rest of 2022. The first very real possible outcome is that we see a market almost identical to what we saw in 2018. What happened was inventory levels continued to rise throughout practically the rest of the year. And we didn't really reach a stasis until the beginning of 2019, where we saw more of a stabilization in the market. And even the spring market in 2019, which is traditionally a very good time to sell, wasn't as fruitful for home sellers as it was before. It really took almost 2 full years for the market to recover from that stabilization period. Now, housing prices didn't really go down that much during that time frame. Now, significantly, I'm talking more than 10% over that time frame. Some pockets, some communities definitely had that happen. But when we look at the market as a whole, the prices did not drop very dramatically from that slump in April of 2018 all the way through the beginning of 2020, right before COVID hit. So the first very real possibility, the first very real outcome is that we see a market very similar to 2018, where really the buyers have more control, more power than they have in a long time. Is it a buyer's market? Not really. You know, when you think about a true buyer's market, there needs to be like 6+ months supply of homes. And I just don't see that happening. Now, there's an argument to be made for the fact that the internet has made it so that economic definition of a buyer's market is actually outdated. And it's more like maybe like 2 to 3 months of housing supply before it really truly feels like a buyer's market. Whether you want to advocate for the former or the latter, the truth is this, is that buyers will have more power and more control in this housing market, could have more control in this housing market for the next 2 years. That is a very real possibility. Just because they have more power, it doesn't necessarily mean that we're in a true buyer's market. There will still be the best homes on the best streets, with the best upgrades, with the best schools. Those are still getting multiple offers. And maybe they're not getting 15 to 20 offers, but they're still getting maybe like 3, 4, 5. That's a very real possibility, a very real outcome over the next 2 years, 12 to 24 months, that we see that happen very similarly to 2018, 2019. So that's outcome number 1. Outcome number 2 is a little bit more dramatic. Now, keep in mind that what is happening right now is reactionary. What are we reacting to in real time? Well, number 1, buyers are reacting to the interest rate hike, as well as the stock market nosedive. Well, those two things will correct themselves in due time. Let me rephrase that. Actually, they're not going to correct themselves necessarily. Let's look at interest rates. At first glance, the interest rate spike is a huge blow to the system. I mean, a point is literally a 10% increase in payments. So effectively, the Fed has raised home prices by 10%, not to mention the 10% that the market's risen organically through the last like 3 months of just home appreciation. So home values have appreciated 10% and payments have gone up 10%. That's like a net like 15 to 25% swing, depending on which area you're looking in here in the Bay Area. In most areas, that's huge. That's huge. That's like 25% more than we were planning on purchasing. Like that brings down purchase power tremendously. That completely recalibrates the type of home that most buyers are going to be able to afford. That's not an easy pill to swallow. Not to mention that portfolios have taken a nosedive. Now, the stock market situation will correct itself in due time. Will it be 2, 3, 6 months, 9 months, 12 months? Who knows? But that will correct itself. Possible outcome number 2. Just like any change, us humans, we are resistant to change. But in due time, that resistance will wane. And all of a sudden, buyers will come to accept the new interest rates. So I believe that another outcome could be that over the next 60 to 90 days, we experience a huge lull in the market, where sellers are doing their best to recoup whatever money they can salvage. They see their neighbors going on the market. Everyone's going on the market. Oh my gosh, honey, we missed the boat. We got to get the home on the market. There's reactionary behavior there. It's happening in real time, by the way. We're seeing it in the stats, in the data. So there's reactionary behavior there. There's reactionary behavior on the buyer side. Buyers pulling out left and right because of the rising interest rates, because of the stock market, because of, I don't know what's going on. I don't want to make a bad decision. Okay, great. So that narrative plays out for 60 to 90 days. Then what? Well, all of a sudden the Mercury News and the Chronicle and everything, they get word of all this stuff that's been going on and massive headlines at the end of July. Bay Area housing bubble has popped. And that's the front page news for like the next week. And that in and of itself is enough to scare sellers from putting their homes on the market. So sellers pull back. back. And the buyers that were waiting on the sidelines are like, well, I don't think the interest rates are going down anytime soon, honey. In fact, they're probably going to go up. So we might as well get back in the market now that there's opportunity. And that opportunity could incentivize or entice some buyers to come back into the market and scare some sellers away, effectively bringing the market back, not to where it was like, say, in March, but, back to a place where the sellers are way more in control than they will be over the next 60 to 90 days. That is another very real possibility, very real outcome that could happen here over the next 60 to 90 days. If you've made it this far in the video, first of all, thank you for your support. I couldn't make it without viewers like you. If you haven't already done so, please take a second, subscribe to the channel, leave us a like and click that little notification bell. It really helps me out and it helps me get in front of more people like you. It helps me spread this real news, not the fake stuff that you get on most of the media outlets. This is real stuff. This isn't fear mongering. This is simply giving you the facts and a little bit of opinion now and then. And as a token of my appreciation, you can text the word free shirt to the number down below. That's free shirt to the number down below. And we'll get you a free Selling Silicon Valley shirt as a token of my appreciation. That's it for this episode. If you have comments, I would really love to see what all of you believe is going to happen in the market here in the Bay Area. It's interesting. It's a very fascinating time especially to be an agent right now. There's a lot of moving parts, and the ability to solve problems and analyze in real time has proven to be a huge asset for me and for my team. But honestly, no matter the market goes up, down, sideways, our job remains the same. But I'd really be curious to see what you believe is going to happen. So leave your comments down below. This is Danny Gould, everyone. I'm Selling Silicon Valley, and I will catch all of you in the next video.